Good afternoon, everybody. Welcome. It's the Liberty Call for Wednesday, March 2nd, 2022. Hope everybody's having a great day out there. It's hump day. Much better day in the markets. Things seem to have, I guess, kind of calmed down. Plus, the Fed chairman, I guess, was speaking in front of some important folks, and I guess the market really liked that. So we've had a pretty good day in the market. There's still, I guess, conflict over on the other side of the world with Russia, Ukraine, but, we can't really do much about that. Just hope that it doesn't, we don't get too involved in it because simply it is not our problem. So, all right. If it's your first time here watching, please click on the subscribe button. It's probably right around there. Also, like and share with friends and family. I would greatly appreciate it. All right. Well, let's go ahead and see how the indexes did today. Dow Jones was up 1.79%, closing at 33,891. The S&P was up 1.86%, closing at 4386. The NASDAQ was up 1.62%, closing at 13,752. Small caps are also up 3%. The VIX was down 7.74%, closing at 30.74. Certainly a good thing. We'd like to see that VIX start heading down towards that 20 number. Anything below 20 I view as a really good sign. Anything between 20 and 30 is your yellow light, and above 30 is red light. Proceed with caution. All right. As far as the other markets, they look pretty good going into Western Europe. Lots of 1% and beyond. Russian markets were still closed again today, but even in the Eastern European markets, they still look pretty good. Then we get down into the Asian markets, mostly down. The only one I see in the green was an Australian, the S&P ASX 200. It was up 0.28. And the South Korean market, the KOSPI, was up 0.16. But the rest of Asia was down. Nothing too terrible. Most of them were less than 1%. The only one that was higher than that, close to 2%, was the Hang Seng at 1.84. So again, not too bad, all things considered. All right. Well, let's go ahead and dive into. Let's see here. All right. Let's go ahead and dive into this article. Kind of a market recap. S&P 500 in rally mode as Powell signals cautious tread on rate hikes. Written by Yassine Ibrahim from Investing. The S&P 500 jumped Wednesday as Federal Reserve Chairman Jerome Powell confirmed investor expectations for a 25 basis point rate hike in March and said the Fed would tread carefully in the wake of the Russia-Ukraine conflict. The S&P 500 was up 2.1%. Dow Jones added 2, and they pulled back since this article was written. Powell said it was still appropriate to raise interest rates by 0.25% in March. The Fed chief, however, didn't rule out a possibility of a 0.5% rate hike at subsequent meetings if inflation continued to run hot. My guess is it will continue. The 2-year Treasury yield, which is sensitive to Fed rate changes, jumped more than 15%. Excuse me. The backdrop of rising U.S. Treasury yields helped bank stocks pare some of their recent losses. Signature Bank, Comerica, SVB Financial jumped more than 6% today. Energy also racked up gains as U.S. oil prices jumped to their highest level since 2011 after OPEC and its allies showed little incentive to curb the surge in oil prices, sticking with the plans to increase productivity by 400,000 barrels per day in April despite supply fears. The market appears to be increasingly pricing in an outage of Russian oil shipments. More and more Western oil companies are announcing their withdrawal from Russia. Commerce Bank said in a note. The Russian invasion of Ukraine will remain in focus as both sides are set to discuss ceasefire at upcoming talks on Thursday. The move from major oil producers to keep production steady comes just as U.S. oil inventories fell by more than expected 2.6 million barrels for the week ending February 25th. Tech stocks held firm as U.S. Treasury yields climbed, with big tech and chip stocks leading the upside. Big tech, including Apple, Amazon, Microsoft, Alphabet, and Meta platforms were in the green. The earnings front also offered investors some solace, with Nordstrom and Salesforce posting stronger than expected results. Salesforce reported quarterly results that topped expectations and raised its full year guidance pointing to a healthy demand for the digital transformation. Its shares were up more than 1%. We believe further margin expansion into 2023 and the continued integration of Slack for Salesforce will ultimately be key for this for the street looking forward, Wedbush said as it raised its price target on the stock to $315 from $275. Somebody needs to correct that. Nordstrom rallied more than 36% after reporting fourth quarter results that beat analysts' expectations, and the department store retailer painted an upbeat picture about the year ahead. In other news, Ford Motor Company outlined its plans to split its auto business into electric vehicle unit and legacy gas and diesel unit, with latter expected to serve as a cash engine to fund the automaker's EV expansion. So, again, I'm not a big fan of electric vehicles, especially in its current configuration. The batteries are too big, too heavy, and don't take too long to charge. They're a fire hazard. So, I mean, there's a lot of problems with the EV market. Hey, if they fix all those problems and you can get a charge that gets you further than 200 or 300 miles, hey, maybe that'd be something to consider. But where I live, everything is far away, and it's just not a very practical use, especially as cold as it gets here. I can't imagine those batteries would hold charges like they would in warmer climates. All right. Some good news here. U.S. job growth more than forecast in February. ADP data shows. This comes from Bloomberg. U.S. companies in February added more jobs than forecast as COVID-19 cases dropped and restrictions eased, encouraging more Americans to work. I can't imagine people weren't wanting to work before this. Businesses' payrolls rose by 475,000 last month, according to ADP Research Institute data released on Wednesday. The median forecast in a Bloomberg survey of economists called for a 375,000 rise. The initial January print showed a 301,000 plunge in the month, the worst since April of 2020, but was revised up to a $509,000 person gain. Greater than expected job growth points to a labor market rebounding strongly from the Omicron variant spread in January, which led to business closures and kept many workers at home sick. COVID-19 cases have dropped significantly and restrictions are easing across the country, which should help wary Americans get off the sidelines and back to work. The data precedes Friday's monthly employment report from the Labor Department, which is currently forecast to show that private payrolls increased by 383,000 in February. The ADP figure doesn't always follow the same pattern as the Labor Department's data. ADP's payroll data represents firms employing nearly 26 million workers in the U.S. Last month's large companies showed that they were well poised to compete with higher wages and benefits offerings and posted the strongest reading since the early days of the pandemic recovery, ADP chief economist Neela Richardson said in a statement. Small companies lost ground as they continue to struggle to keep pace with wages and benefits needed to attract a limited pool of qualified workers, she said. Companies with fewer than 50 employees lost 96,000 jobs in the month, while large businesses gained 552,000 jobs. Service provider employment rose by 417,000 in February, led by leisure and hospitality, trade and transportation, and professional and business services. Payrolls at goods producers increased by 57,000. So some good news. It looks like the payroll numbers look a little bit better. Looking at just the total employed. 2 years ago at this time versus today, there's still a gap. Seems like people kind of gloss over that and like to talk about, well, we've had the most job creation, blah, 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 in X number of amount of time. Well, problem is that, the government, the powers that be told us to stop working, and it totally slowed down production, laid off a lot of people. And so not really job creation. It's more like people going back to the employment that they had before. All right. Let's see what we got here. Next article. Doug Kass, the great bear market of 2021-22. This comes from Real Money. All right. Let's see what we got here. The averages are lying to investors. We have been in a profound and significant bear market since last summer, as numerous individual securities have cratered. I continue to be bearish and am of the view that we are in a trading sardine market and not an eating sardine market. However, the under the surface, God, what is this word? Skimming of stocks could mean that investors should be alert to emerging opportunities in a number of individual equities that have already been taken to the woodshed. Let's see here. Since early summer 2021, the increased number of equities have become unglued from averages. What some are beginning to realize is that we have a bear market for many stocks for months. So individual equity opportunities may be developing, suggesting that some of the more bearish market views might be tempered. From one sector to another, a systematic bear market has engulfed the U.S. Stock market, even though the senior indexes are down only modestly. Stay-at-home stocks embraced 18 months ago, for example, Peloton and Zoom, are down by 50 to 75%. Meta platforms, dramatic decline of 46%, is the world leader to the downside in capitalization terms. The number of 2021 IPOs are trading lower than their offering prices. The Renaissance IPO ETF, which tracks initial public offerings, is down 45%. SPACs, a flawed concept that ensures the benefit of sponsors and not the investors, which had inexplicable share appreciation at the get-go, have been uniformly decimated. The promise of EV startups, either through SPAC mergers or issued independently as IPOs, have evaporated, with darlings like Rivian and Lucid losing more than 2/3 of its value. Conceptual real estate plays shot to the moon in price and have been obliterated in their return to earth. Compass, Zillow, Redfin, and Opendoor are on average down 70%. Other concept stocks like Avis has gone from $545 a share to $185. GJAWS have been, I'm not even sure what that is, have been left like orphans. Many are down 50% or more. And then there's ARK, which is Kathy Wood's hedge fund, has gone from $160 down to $65. It's probably most, if not all, of the aforementioned sectors and stocks will never return to anywhere near their 2021 share price peaks, though I remain bearish on the GJAWS. Let's see what GJAWS are. Let's search for that. What is a GJAW? A showy thing, especially one that is useless or worthless. Okay. So he's bearish on worthless things. Some recovery in a number of stocks mentioned is likely, though the averages are still being propped up by Microsoft and Apple. The great unwind described above in a number of equities is eye-catching. So many stocks have declined inch by inch, step by step. So that's while the end, like he's pointing out, the indexes still look fairly good. I mean, they are certainly off from from the first of the year. And I certainly have been, exclaiming that, we're due for some real pain in the stock markets, over the next, could be year or two. But, this certainly points out, those that have certainly plummeted over the last year or two. All right. Last article I got here, Stagflation is Coming and What You Need to Know, written by Lisa Belfus. All right. There is no question that Russia's invasion of Ukraine is going to push inflation higher, given the amount of energy and food commodities produced by the region and the responses by countries and companies worldwide. What is less clear is whether this worsening period of inflation will turn into stagflation. Since Russia began its invasion of its neighbor, the price of wheat has risen more than 20%, and the price of crude oil is by about 10%. The world's biggest shipping companies, which together control about a third of the world's container fleet, have meanwhile said they would suspend all deliveries to and from Russia, notes Eddie Donmez, director of Amplified Trading. Those moves will exacerbate strains in supply chains and lead to price increases for food, fuel, and more at a time when global central banks are just starting to move to combat price pressures. With consumer price inflation in the U.S. already running at an annualized pace of 7.5%, the highest in about 4 decades, and far above the Federal Reserve's long-standing 2% target, investors should brace for even higher prices for even longer. The question then becomes, whether central banks will prioritize price stability and keep tightening monetary policy at the expense of growth. Against this backdrop, it makes perfect sense that investors and economists are increasingly worried about the worst of both worlds scenario of high prices and slow growth. It's the economic call du jour, which shouldn't be all that surprising. But how likely is stagflation, and what is an investor to do in the face of it? Here's a rundown of what it is, what the odds of stagflation are rising, or why the odds of stagflation are rising, and where investors can seek cover. What is stagflation really? Economists broadly consider stagflation to represent periods of high prices and slow growth, as Peter Bachvar, Chief Investment Officer at Bleakley Advisor Group, puts it. Stagflation is a central bank's worst nightmare. But what is high and what is slow? It depends on who you ask. Jim Paulson, Chief Investment Strategist at Luthol Group, says stagflation, by its simple definition, isn't as uncommon as it might seem. It's mainly a term associated with the 1970s, but Paulson says most recoveries end with stagflation, often before turning into a recession. Could we have stagflation? Absolutely, says Paulson. In fact, we're already in it. If stagflation is already upon us, how worried should we be? While prices no doubt stay higher for longer, Paulson still expects the consumer price index to slide to around 4% by year end, as inflation-adjusted gross domestic product cools from 5.5% in 2021 to about 4%, slowing growth and elevated inflation, but not quite a recipe for stagflation, he says. The time to worry, Paulson says, is when you see most economically damaged aspects of high prices and slow growth. It's when corporate profitability becomes compromised. That's when things get hairy. Companies respond by cutting jobs, which then kicks off the kind of high employment or unemployment that helped characterize the 1970s. The situation in Ukraine has unleashed de-risking that implies bond markets are increasingly pricing in stagflation, says Lisa Shalit, Chief Investment Officer at Morgan Stanley Wealth Management. U.S. inflation break-even curves, which indicate market expectations for future inflation, have blown out, she says. 2-year inflation expectations are near 4%, as nominal yield curves at the flattest since the pandemic's onset reflect downbeat economic growth expectations. We remain wary of Fed policy uncertainty and execution. Rebalancing of consumption and inflation impacts on profit margins suggests lower multiples, weakening earnings revisions, and a wider term premiums and credit spreads, Schlatt says. She adds that sensing complacency around the sustainability of operating profit leverage, as demand was likely pulled forward by the pandemic, and as nearly 3/4 of earnings guidance has so far been negative. At MSCI, Daniel Szabo and Thomas Verbaken lay out a grim scenario where the conflict in Ukraine continues and the West responds with multiple rounds of long-lasting sanctions. As energy prices surge to significantly higher levels, fears of supply chain bottlenecks push up longer-term inflation expectations, further weaken business and consumer confidence, and slow economic growth. In this scenario, central banks are caught between two fires and cannot postpone monetary tightening for very long. They say, meaning stocks plunge, credit spreads rise, and the U.S. dollar gains versus the euro. Could the Fed instead choose to protect growth over fighting inflation as it prepares to begin withdrawing extraordinary pandemic aid and lift interest rates this month? The Fed hopes to orchestrate a so-called soft landing and avoid a recession. I'm not sure that's going to happen. Schlatt thinks the central bank will prioritize protecting growth over defeating inflation, but she says walking back from its current projected policy path is hugely risky, setting the bar for a subsequent policy pivot very high. Ed Yardeni, president of Yardeni Research, said he could see the Fed raising its inflation target to 3% from 2% in an effort to claim victory on inflation sooner and with less harm to growth, even if that is at the expense of faster price inflation over the longer term. All right, so where are the best places to turn? Given mounting uncertainty over how inflation, recession, and stagflation will play out, Schlatt recommends sticking with quality, strong cash flows, and earnings availability that isn't fully priced. Financials, materials, energy, consumer services, and healthcare look rife with opportunities, while domestic small caps and emerging markets may enjoy longer-term valuation support, she says. Paulson of Lefthold Group says the odds of The odds favor the conflict in Ukraine ending relatively soon, meaning inflation sputters from current levels in the coming months. He thinks Australian and European stocks will be the biggest beneficiaries of peace, and his favorite play on such a scenario is to buy emerging markets, excluding China. As a stock investor, I love the combination of accelerated and intense fear with good economic and corporate fundamentals, Paulson said, suggesting investors also consider equal weighted exchange traded funds that effectively deliver small cap cyclical exposure. That's as opposed to market cap weighted ETFs that are dominated by the likes of Amazon.com. As for his full-blown stagflation, strategists say the best moves are into commodities. Bakhvar of Bleakley Capital emphasizes metals as miners, oil companies, and fertilizer manufacturers. Then there's cash, with Bakhvar saying it's is probably and unfortunately the safest place to be during the kind of stagflation stretch he says is already underway. All right, so there's some views of couple of different folks in the investment world and their views on whether or not what's going to happen with inflation. Will it lead to stagflation? And some areas, definitely some areas I've talked about, commodities, metals, oil and gas, services sectors, hospitals, things like that, things that are still going to get used even when the economy does go through some hiccups or hit some roadblocks. People are still going to eat food. People are still going to get sick. They're still going to drink. They're still going to buy cigarettes. Usually the vice stocks go up when the economy starts to go bad. So your Philip Morris's and your beer companies and your alcohol companies usually do fairly well when the stuff hits the fan, so to speak. So, all right. Well, that's everything I have for today. I hope everyone got something from this. If not, I'll try better tomorrow. All right. So I hope everyone has a fantastic evening, and I'll be back tomorrow with Thursday's Liberty Call. So y'all have a good night.